Investing can be confusing, especially for beginners. Choosing the right place to put your money is important for reaching your goals. Index funds and exchange-traded funds, ETFs, are two popular and easy options. They both offer low costs, good diversification, and are simpler than picking individual stocks. Although they aim to help you grow your wealth, they work in slightly different ways. This video clearly explains what they are, how they work, and how to decide which one is right. For you, what are index funds? Index funds are a type of mutual fund designed to replicate the performance of a specific market index, such as the S&P 500, which comprises 500 of the largest publicly traded companies in the United States. Unlike actively managed funds, where a fund manager selects stocks to outperform the market, index funds operate passively. They hold all or most of the stocks in the target index in the same proportions, ensuring that the fund's performance closely mirrors that of the index. For example, investing in an S&P 500 index fund means your money is diversified across major companies like Apple, Microsoft, and Amazon. And if the S&P 500 rises by 10%, your investment should see a similar increase, minus minimal fees. How index funds work. To invest in an index fund, you purchase shares through a brokerage account or directly from a mutual fund company. The price of an index fund is determined once daily, at the close of the trading day, based on its net asset value, NAV, which reflects the total value of the fund's holdings divided by the number of shares. Some index funds require a minimum investment, often ranging from $500 to $3,000, although many providers now offer options with lower or no minimums to accommodate smaller investors. One of the standout features of index funds is the ability to set up automatic contributions, allowing you to invest regularly without manual intervention, which is ideal for building wealth consistently over time. Benefits of index funds. Index funds are highly cost-effective with expense ratios, the annual fees charged to investors, typically ranging from 0.2% to 0.10%. This translates to just $0.30 to $1 per year for every $1,000 invested, making them one of the most affordable investment options available. Their diversified nature spreads your investment across numerous companies, significantly reducing the risk associated with the poor performance of any single stock. Index funds are also remarkably simple, requiring little knowledge or effort to manage, which makes them particularly appealing to long-term, hands-off investors. Drawbacks of index funds. Despite their advantages, index funds have limitations. They offer limited flexibility, as trades can only be executed at the end of the trading day based on the NAV, preventing investors from reacting to intraday market movements. Some funds still impose minimum investment requirements, which can be a barrier for those with limited capital. By design, index funds aim to match, not exceed, the market's performance, so investors forego the possibility of outperforming the index. What are ETFs? Exchange-traded funds, ETFs, share similarities with index funds in that they often track a market index, but they differ significantly in their structure and trading mechanics. ETFs are traded on stock exchanges, much like individual stocks, allowing investors to buy or sell shares throughout the trading day at market prices that fluctuate in real time. While many ETFs are passively managed and track broad indices like the S&P 500, others focus on specific sectors such as technology or healthcare or investment themes like clean energy or emerging markets. For instance, an S&P 500 ETF holds the same stocks as an S&P 500 index fund, but offers the added flexibility of intraday trading. How ETFs work. Investing in an ETF requires a brokerage account, through which you purchase shares just as you would buy a stock. Unlike index funds, ETFs have no minimum investment requirement beyond the cost of a single share, which can be as low as $20 or $50, making them highly accessible. ETF prices are determined by supply and demand in the market, and they can be traded at any time during market hours. Benefits of ETFs. ETFs are known for their flexibility, allowing investors to buy or sell shares at any point during the trading day, giving them greater control over the timing and price of their transactions. Like index funds, ETFs boast low expense ratios, often matching or undercutting those of index funds, sometimes as low as 0.03%. Their low entry point makes them ideal for investors with limited funds, as a single share can provide exposure to a diversified portfolio. ETFs also offer diversification by spreading investments across multiple companies or assets, and their extensive variety, covering everything from broad market indices to niche sectors, provides investors with a wide range of options to suit their interests. Drawbacks of ETFs. However, ETFs come with potential downsides. Trading costs, such as commissions or the bid-ask spread, the difference between the buying and selling price, can add up, particularly for frequent traders. The ability to trade throughout the day may tempt investors to make impulsive decisions, which can undermine long-term returns. The sheer number of ETF options can also be overwhelming, making it harder to select the right one compared to the straightforward nature of index funds. Comparing index funds and ETFs. The differences between index funds and ETFs primarily revolve around trading mechanics, accessibility, and investment options. Index funds are traded once daily at their NAV, often requiring higher minimum investments, while ETFs can be traded throughout the day at market prices with no minimum beyond the cost of one share. Index funds typically incur no trading fees, whereas ETFs may involve commissions or bid-ask spreads, though commission-free options are increasingly common. Index funds are generally limited to broad market indices, while ETFs offer both broad and specialized investment choices. In terms of flexibility, ETFs have the edge, but index funds excel in simplicity and ease of use. Choosing the right option for your portfolio. Index funds and ETFs are both great tools for building wealth, especially for long-term investors. Index funds are ideal for those who prefer a hands-off approach. They work well in retirement accounts like 401ks and IRAs, often with no trading fees and low minimums. They're perfect for automated, consistent investing without worrying about daily market changes. ETFs, on the other hand, offer more flexibility. They can be traded during market hours and are good for people with limited capital or those wanting to target specific sectors. Key considerations before investing. Regardless of whether you choose index funds, ETFs, or a combination of both, several factors should guide your decision. Always examine fees, including expense ratios and any trading costs, as even small differences can significantly impact your returns over decades. For instance, a 0.5% fee versus a 0.05% fee on a $10,000 investment over 20 years could result in thousands of dollars in additional costs. Align your investment choice with your financial goals. Index funds are better for long-term objectives like retirement, while ETFs may suit shorter-term or tactical strategies. Ensure your portfolio remains diversified to mitigate risk and resist the urge to frequently trade ETFs, as this can disrupt your long-term strategy. Both index funds and ETFs are tax efficient, but if you're investing in a taxable account, consult a tax professional to understand potential tax implications and minimize surprises. In conclusion, index funds and ETFs are excellent choices for long-term investing, offering low fees, diversification, and ease of use. Your decision should reflect your personal goals and preferences. Index funds for simplicity, ETFs for flexibility. Either way, the path to wealth is built through consistency, patience, and time. Start small, stay invested, and let compounding work in your favor to build a stronger financial future. If you like this, please subscribe. It helps. Thank you.